why don't you, if we're going to get started formally, why don't you kick things off? Then we can go around, provide some context for, for the call.
Okay, hello everybody. I'm Bonnie Halper. I write the weekly Startup One Step newsletter, which has a very opinionated editorial, and then, as Thomas well knows, and then we also include links to information that startups should know. For example, we've been running links about VC and angel funds that are actively investing right now. That's been there. Anyway, and every 2 weeks we host a breakfast with one investor. Today we have two, right? Allison is here too, because we have New York Venture Labs and they have a deadline coming up fairly soon, and a small group of entrepreneurs. So it makes it very one-on-one. You can get your questions answered. And we want to thank KettleSpace for hosting us. We usually do it in person. KettleSpace is a very affordable restaurant co-working, but we don't know when that's going to open up again. So KettleSpace has a platform now. Mac, you want to talk about that? Mac is from KettleSpace.
Sure. Hey guys, everybody. I'm the event coordinator for KettleSpace. So like Bonnie said, we were a New York City-based co-working company that turned kind of restaurants and hospitality spaces into co-working spots. A lot of you I see on the call were in the spaces. Post-COVID, we started a free platform where members can connect, swap skills and advice. We have a Slack message board. You got a huge list of discounts on products. And you'll get a link to sign up for that platform after this. Bonnie and Startup One Stop has been a great partner to us and given our members access to countless experts for years. So happy to have you, and thanks to Allison and Thomas for joining us today. Back to you, Bonnie.
So Thomas and Allison, do you want to kick it off, or do you want to have people introduce themselves? The way we do it is that we introduce the investors, and of course, because MVP Labs has a deadline coming up, I'm sure a lot of you are interested in knowing more about the labs and what the program is and how they're doing them virtually right now. So do you guys want to talk, or do you want to?
No, I think it makes sense, right? Because
Okay.
that'll give people some additional kind of context, and then we can do the all the intros, which I think is just a great feature of events like this, where everyone gets to say a little bit about who they are. It usually takes a little while, but I just find it to be kind of a great way to run these kind of meetings. Again, thank you, Bonnie. It's good to be back. Bonnie and I have known each other for a long time, and I don't know how many of these I've done, but it's certainly been a few. And I look forward to doing more, and as we were talking about, back to in person. So I'll give a little background on Newark Venture Partners and a bit about my own background, sort of set the stage, and then I'll let Allison, my colleague, talk a bit about the MVP Labs program, which is part of our investment platform. So Newark Venture Partners is a venture firm. It's been around for 5 years now. We are based in Newark, New Jersey, which you can probably tell from the name. I founded the fund with the CEO, founder and CEO of Audible, which is a division of Amazon. Many of you probably know them as the audiobook company. They've been headquartered in Newark for a long time. And I met Don probably 6 years ago now, about a year before we launched the fund officially. And he had a vision has a vision to help Newark rebound, continue to develop. It's been on the rebound for a while. And his thought was, look, Audible's been incredibly successful there. They moved in 2009, I want to say. No, 2007. 2007. We got bought by Amazon, came with 100 people. They're now several thousand there. That's their world headquarters is in Newark. And Don's a very socially progressive guy. He founded or brought Audible there because he believes that companies, should really do good while they're doing well, and wanted the firm's presence there and all its people there and its mission there to be aligned with an urban comeback of Newark and doing well there. So it's not about giving to the United Way. It's about positioning the company and all of the money it spends and all the employment it has as a benefit, economic benefit to an urban core, and it links up with their internal culture and all. So anyway, his thought was we had 10 more audibles in Newark, be a very different landscape, and 10 audibles in the sense of high growth tech companies, tech-based companies. The economic landscape there would just be different. And how do you get 10 more audibles? You get them by attracting startups and attracting high growth tech companies. And a key element of that is having venture capital available and incubation and all those things. So Newark Venture Partners is sort of a key aspect of that, right? Let's get a venture fund going that is backed by the right people and is based in Newark and focused on that as part of its mission. So Newark Venture Partners, the first fund we raised, it was a $44 million fund. We invested from 100,000 up to $1 million in pre-seed, seed, Series A stage companies. We deploy capital through kind of two tall platforms. One is MVP Labs, which is like an accelerator. I think we differentiate ourselves a bit from that, and Allison will talk about that. Many of our companies are kind of post-accelerator. Maybe half of them have already been to a traditional accelerator, and choose to join us for reasons that we'll get into. And then we also invest directly, outside of the program, or a lot of which, maybe third to a half of those investments go into alumni of their venture partners, so into the labs. So we'll again talk about that more. And we reached the kind of end of the investment period of Fund 1 right around the end of last year, and announced the first close on Fund 2. So we closed on 46 million toward a $100 million goal for Fund 2. That was in January of this year, and we've begun deployment of that fund again through the same model, with some some slight changes. So through labs running that program, and again directly, and we can go with the new fund with larger checks. We'll go up to 2 million out of the new fund, and in addition, we continue obviously to support our existing portfolio, which is over 70 companies from Fund 1, and growing out of Fund 2. And among those 70, there's about 25 where we have a larger position in, meaning beyond what the labs program does. So I'll hand it over to my colleague Allison.
Oh, I have one quick question. Oh,
sure, go ahead.
One, do you lead rounds?
Yes, we do. We lead, we co-lead, and we participate. We're relatively agnostic that. It depends on kind of the company and the situation and our conviction.
Okay, part 2, which is very important for anybody who wants to go into an accelerator. You've had quite a few exits, which is very important with the accelerator. Yes.
Yeah, well, yeah. I mean, to put a finer point on it, we've begun to have exits out of the portfolio. It's a young one. We invest, think about it. Most of the investments, even in Fund 1, are 2 years or less. So it takes some time for things to. We have had a few early exits, right, which are exciting. If anything, though, in the world of venture, your best companies are the ones that continue to grow and will take a little longer. So that's good. Personally, I've had some great exits of my own, because prior to this, I guess I do want to say that too. I invested out of my family office, one that my wife and I started, and I've invested out of that in about 30 companies and about a dozen funds. So I'm an LP in through the family office in Greycroft and FFBC and Brooklyn Bridge Ventures, Charlie O'Donnell's firm, and a number of others. So I have kind of that direct investment experience. And out of that, I've had probably 4 or 5 significant exits, which is kind of gave me the groundwork and the interest in launching Newark Venture Partners.
Allison, sorry, I didn't mean to cut you off.
No, we need you, Bonnie. We need you to ask the questions.
Yes. Definitely. Okay, great. Yeah, thank you, Tom. That was an excellent intro to Newark Venture Partners. My name is Allison Williams. I run Newark Venture Partners Labs program, and I'll get into more of that in a moment. A quick note on my background is that I used to be a founder. So I started a company in 2011 that was in the photo cloud storage space. So for the founders on the line, I've been in your shoes before. I know how hard it is, and I have so much respect for the work that you do. And it's really been an honor to come into Newark Venture Partners and take on the role of running labs, because I really felt that because of my experience, I understand the journey of an early stage founder, the ups and downs, because there are many of those. And I could help, find the right companies, but also help provide the resources that really move the needle for an early stage company. And that's something that MVP really prides itself on. We're not here to, just give advice. We really have created a program that adds real value to your business. And what we say is we help you grow smarter and faster to get to your goals more efficiently and sooner than you would normally. With that, let me just go into a little bit more about the program, and then Tom and I are really excited to answer any and all of your questions. So what does MVP invest in? We look for B2B SaaS companies. We really don't invest in direct-to-consumer plays. We have 7 corporates who have funded Newark Venture Partners. You'll find them on our website: Central, Panasonic, Bank, Dun & Bradstreet, RWJ, and Horizon Blue Cross Blue Shield. And we use our LPs as a way to really get insights into the technology opportunities within the verticals of healthcare, audio, voice, supply chain. And that really does build the theses that we use to go out into the market. So some areas we're really interested in for this cohort are supply chain, health tech, voice, and audio. We can invest outside of that. We will invest outside of that. Those are just particular areas of interest. So founders on the line, just like when you are making a sale for your company, you have to qualify the lead that you have. You have to make sure you're selling to the right person who actually wants to buy whatever it is you're building. Same thing with venture. There are so many funds out there, but you need to make sure that you find the fund that is investing in what you do. Talking to venture capitalists, it's a game of getting a lot of no's. 97% will be no's. So, don't take it personally. You may just not be within the scope of what they invest in. It's nothing personal. It's just not a fit. Or if you are, it's a great opportunity to get feedback. And then, you can really ask for feedback if you want it. I got to a certain point where for myself where I actually, wasn't as interested. Sometimes I would be interested, sometimes not. Depends on who you're talking to. So you can think about that. So that's what we invest in. As Tom mentioned, our bread and butter is really leading a seed or Series A. We can invest $1 to $2 million, which is, an awesome opportunity for a company that really wants to get off the ground and start scaling quickly. That's not what I do, and that's not what we do at Labs. At Labs, we invest a small check, $100K. And while that sounds small, there's 2 major benefits that come with it. One is you get our entire platform support program, and I'll go into that in a little bit more detail. But it's a really differentiated program that we've built, and I'll talk about that. And then secondly, you get prioritized for that direct investment arm. So we you know, if I'm doing my job well, we are investing and we are wanting to lead in a seed or Series A, or at least wanting to participate strongly. So you get that prioritized look from the direct investment arm. And then also, you know, it's 100K, which is also really great for an early stage company, and that could extend your runway by another 6+ months. We do look for, as Tom said, we're kind of, you know, post-traditional program. We do look for traction in the market. And the reason, I mean, there's a bunch of reasons why we look for that, but, you know, a lot of it has to do with the fact that we have an execution team that really can only make a big impact if you market and you can actually apply the things that we're doing in real time. So the right timing for us is that we look for around 10K of monthly recurring revenue. The other way to look at it is you're going to be raising your institutional seed round you're going to start to raise your institutional seed round in about 3 to 6 months. And that's going to take, you know, it typically takes about 6 months to close a big institutional round. So that's the timing that's really the perfect fit for us. Okay, so on our program, so a great way to simplify it, and I did put a link to our labs page on our website, which also goes into really great detail on what we offer. But I can summarize it in 3 main pillars. The first pillar being in-house execution support. It's heavily focused around sales. So, you know, there's a lot of programs out there who provide mentorship and advice. We love that, but we were much more focused on hands-on execution support. So when you come into the program, you get 5 in-house experts that have worked with NVP for a few years now. One person, probably the most critical person in this group, is Kevin Petrie, our director of growth. He has extensive experience in sales. He led sales training for Groupon with pre and post IPO. He's worked with every single business model. He has had a transformative impact on the founders that he's worked with at MVP. He really breaks down your sales process now, gets to understand it, and then works with you to rebuild it. And it's an end-to-end broken down process that you get at the end of it, where you really understand exactly who you're looking for, and then how you're closing the deal, and that can be a pretty long sales cycle. And he defines it from beginning to end. So you work with Kevin, and then once the sales process starts to get fleshed out, you'll be bringing Sean Simons. Sean is our BDR manager. He manages a group of BDRs that we recruit from local universities in Newark. Usually they're seniors in college. They can be recent graduates. While that sounds young, we actually kind of like that because these are very coachable, smart kids that we bring in, and you get your own BDR who then takes the sales playbook that you built with Kevin and executes it. So finds leads, qualifies them, and then moves them to the right person within the org. We also have Jen Solomon, who is our PR expert. She's excellent. That's bringing in someone to support on PR was important for me, because what I found as a founder is that while press, a lot of the times it's, you know, somehow bought, and it doesn't really mean much. It actually is important for you to substantiate your business to potential buyers, and also it's a really good signal to investors. Comes in and helps you get headlines. We bring in a finance expert, Joe Manginelli. He actually comes from a firm called Calculate, who works with you to build your financial model. So it really helps you understand your financial metrics, become fluent in your metrics, and then also helps you be able to answer all of those questions that a finance person within a venture fund are going to ask you. So to get you fluent in that. We have Dan Crane, our operating partner. He's a serial entrepreneur from New Jersey who has been in your shoes many times, has had numerous successful exits. He works with you on product roadmap, how to kind of manage the customer pricing, things of that nature. So that is the team that we bring in to support you, and that's our expert support team. It's all one-on-one support for you on your schedule. Secondly, we have our LPs, are those 7 corporates I mentioned. Yes, they help us guide our investment thesis and our understanding of enterprise needs, but they're also there to mentor our founders. So we have over 500 mentors from across our 7 corporates who have raised their hand to say, I want to support MVP. What does this give our founders? It gives our founders the ability to find the absolute best talent in different functional expertise areas where you need more guidance and support. So like data science, we can find you the best data science person at Audible, and that's an incredible team. It also, from our LP standpoint, a lot of people in corporate, they have an itch they want to scratch to get involved in the startup ecosystem. So this helps them, get involved, and it's really fun for them. So it's a win-win. Also, we have a great track record of our portfolio actually closing contracts with our corporate LPs and doing it in a timeline that is really unthinkable, but things accelerate because of the relationships that we have with these corporates. And then lastly, getting you in front of investors. Something I learned as a founder is that, fundraising, a lot of fundraising success has to do with existing investors advocating on your behalf to other investors. And the hardest part is kind of cracking into that. And we provide a lot of support for our founders, just advocating on their behalf to the investor community every day. Tom and I are doing that every day, but also within the program, we have some scheduled events that get you in front of investors that we really respect. So one is we do an investor roadshow where you meet with investors one-on-one. It's kind of a speed dating format, but it's a fantastic, it's a half a day. You meet 50 different investors. We've always had great success from that event. We also do a demo day. So those are the 3 pillars. Happy to answer any questions you have on them. Quickly, I'll touch on
Your sound breaks up a little bit.
Virtual. We had to do that. I'm sorry?
Oh, your sound is breaking up. Is anybody else
Can you
hear that? Yeah, your sound breaks up a little bit.
It is. Oh, I'm sorry. I'm sorry about that. If it's really bad, I can.
No, it's interesting. It happens for a couple seconds.
Yes.
And then it's back, right? But why don't you, given that's important, you were saying about, actually, why don't you just jump straight to that? When is the next labs class, and what does that application process look like?
Okay, great. So the next labs class starts September 21st. You can apply on our website. So I put the link in the chat area, and you can apply there, and we'll get back to you, within a week. You also can just email me. I'll put my email here. Either way, you're going to get to me. The applications go right to my email anyway. You can email me. You can say we met here. You can attach your deck, and we will review it. We review every application that comes in. So yeah.
Yeah, and just to kind of reiterate, because I think this notion of fit to investors is a really important one, which is you can waste all sorts of time talking to investors who just don't invest in your sector, right? And or not investing at your stage. So understanding kind of fit to them, right, is just super important. And fit for us, as Allison was saying, is we're B2B. We really don't invest in direct-to-consumer companies. Within B2B, we're pretty broad. We have some areas where we've invested more. We have, thesis around, but we'll do others. Those areas where we've done a fair amount of investment really often align with the LPs that we have in the fund. So we have a large set of investments in health tech. One, because we think that's a great emerging area where technology is doing a lot of great things, and there are great pool of founders out there working on it. But it's also because we have Horizon Blue Cross Blue Shield, which is the largest health insurer in New Jersey. And we have RWG Barnabas, which is the largest hospital system in New Jersey, both as limited partners in both Fund 1 and Fund 2. And they're very actively involved in things. So it gives us a unique perspective there. We're also interested in supply chain. We also do things in audio, again, aligned with things that we have in common with our LP. So that's kind of about fit, right, relative to that. So B2B, We love to be, in market with a product is our sweet spot, generating some level of monthly reoccurring revenue, lower limit somewhere around 10K a month. And this is labs we're talking about, and anywhere up to even 100K. We've had companies coming in with $1 million of annual traction, but are looking to, kind of jump from that into the next step.
So Allison, you said that the next cohort start on September 21st. I thought that was the deadline for applications. September 21st. Oh, you're muted. I'm sorry, Alice.
Bonnie, can you hear me?
Yeah, now we can.
Is it better? Okay, I dialed it on my phone. I'm sorry, your question was about the start date?
Yes, I thought the deadline for applications was September 21st.
I'm sorry. The start date of the program is the 21st, and the application really the deadline is a week before that. I mean, we make some decisions really late in the process, but the start date is the 21st of September.
Okay, I'll change in the newsletter that this. Okay, thank you. So, do people want to very briefly introduce themselves, and then we'll move on to Q&A. Victor.
Thanks, Bonnie. So the great story about MVP, and looking forward to hearing more during the session. So I'm Victor Lee. We're located in central New Jersey near Princeton, and we have a super hotspot app for people who need a fast and secure online access. So we're right now about to launch 2.0, which is optimized for work from home. So our focus at the moment is on sales and marketing versus like a fundraise. But I'm interested in this session because any company that's in the cloud or SaaS, the number one requirement is that their clients be able to access the internet on a system. So, and I've already had conversations with some folks already on this call about helping them. So would love to chat with anybody and everybody on this call, and also obviously with Allison and Thomas to see how we might be able to help some of their companies. Thanks a lot.
And people, feel free to put your LinkedIn or contact information in the chat. Bob, are you back? I'm just going through the list. Bob, you? He was having technical issues earlier. Oh, you're muted. All right, Daryl, you want to briefly? Daryl? Oh, you're muted as well. Just.
Is this a forced mute, like on your part, or
no,
like
not at all.
Is this sort of a self-inflicted mute?
Hello.
One...
Oh, there's Daryl.
Sorry.
So briefly talk about who you are and what you're doing.
Yeah, I do a lot of things. Primarily, I'm a business coach, but I'm also an investor with projects that are mostly on the back burner. I have one app that I'm pursuing presently, and I have 5 or 6 kitchen utensils that I need to get manufactured. So the whole group of kitchen utensils is something I want to pursue altogether. And the app is what I'm pursuing right now. It's a productivity app. And well, not just an app, on a desktop platform as well. So I need help with that. So that's why I'm here.
Okay. Jose, welcome back.
Hey, Bonnie. Happy to be back. Hey, Victor. Hey, Matt. Daryl, I've been meaning to reach out to you. I know you're also a chef, but hopefully we can connect after
Absolutely, sure.
Hi, Allison. Hi, Tom. It's good to meet you. I'm Jose, co-founder of Pura Market. We're a concierge chef service, so we make it really, really easy to connect local chefs to busy employees looking to buy healthy and even personalized foods. We started selling back in June 15, fairly recently. And through our surprise, after 2 weeks of selling straight to the consumer, we had a wellness program reach out to us because it turns out we felt a significant need. So they're asking to deliver 350 personalized meals to their firefighters. So to our surprise, we fit this wellness program really well. And we're currently working on building more of these relationships. So we're still testing to see if this is where we want to shift. We consider ourselves more of a B2B2C company. If that's something that I know it's not entirely your thesis, but is that something that you've invested in before?
B2B2C is kind of in scope. It's just the more there's a kind of a consumer marketing, need direct consumer marketing, less, in our sweet spot. But in your case, we could get into it. Let's let the other folks kind of introduce themselves, and if there's a specific question you have later, we'll cover that.
Great. We're looking forward to the conversation.
Krishna.
Hey everyone, I'm Jose's co-founder. Originally based out of Long Island, relocated to Florida. You just got the pitch from Jose, so happy to be here and meet everyone.
Oh, so what do you do? You want to briefly talk about what you do or what you're working on right now?
Yeah, so I'm Jose's co-founder.
Oh, okay.
Almost like a Airbnb for chefs.
That was nice and succinct. Thank you. Farah. Farah, do you want to always hear?
Hi, everyone. Hi, I joined a little bit late. I apologize for that. I realized we're in a round of introductions. My name is Farah Arabi. I'm the founder of I2BN. It's a hybrid think tank and consulting organization focused on innovations and international development. And we're really in the very early stages of formation right now. So I'm looking for any insight, inspiration, advice that can come from this more experienced group of people. Thank you.
Kyle, I know that you're muted right now, but you want to briefly introduce yourself again?
Sure. So I work for a family office called Quaker Capital Investments. Had been living in Brooklyn and trying to extend the reach, but it is a primarily Pennsylvania-based network, and our portfolio companies are all connected in some way to Pennsylvania. Similar types of businesses, enterprise software, B2B, not typically leading, but actually the last check we wrote was in effect a lead after reworking the round. Yeah.
Mara.
Hi, I'm Mara. I am an accidental investor, so I'm really just here to learn. I have an advertising background. I've been doing that for 18 years, and I quit my job after accidentally investing in my friend's company. So I'm really just here to learn and listen and observe, fly on the wall.
Any particular focus to your investing?
Right.
Friends. So if you're a friend of mine and you're starting a company and you're like, I need money, I'm going to
Hey, friend.
Yeah.
It was an accident. I really was just hoping to be a fly on the wall and listen and learn from you all. So thank you for letting me sit quietly.
Sure. Pia.
No quietness.
Okay.
You'll have to ask questions.
Hello everyone. So my name is Pierre. I'm actually a founder of Travelers. Obviously I'm doing tourism industry, focusing on eco sustainability. Obviously not super sexy industry right now. But I'm also helping, one of the UK's female entrepreneurship communities called Sprinters. We have weekly support groups for female founder who want to launch their business. And currently we have a premium community, and we're actually looking forward to connect with venture capital. So if you guys have some probably like spare 30 minutes of your time, maybe you would like to help us launch like Ask Me Anything session just to help our female founder how to get on their business, then I would love to connect with you guys in the future. Thank you.
Good. Put your information in. Put your information into the chat.
Yes, everybody. I keep telling everybody you should put your LinkedIn or your contact.
All right, I'll put my contact information. Thank you.
So, Rod, do you want to introduce yourself? Rod? Oh, he's muted.
Bonnie, is it me?
Oh, Badine, go ahead.
Thank you. Pleasure to meet everyone. Thank you, Bonnie. Thank you, Thomas. Thank you, Allison. Thank you, everyone. Thanks to KettleSpace. I'm an attorney. I'm a business attorney in New York, in Manhattan, and I work with the privately held companies and their owners on risk management, and also I find a passion. Find a passion to mentor early stage startups. I'm part of 2 startup accelerators as a mentor, and I look forward to work with Bonnie and Thomas and Allison. Let me know how can I help. Thank you.
Which accelerators? I'm just curious.
I can't disclose. I'm an attorney. I'm bound for.
Oh, okay. Sorry. So Thomas, you want to reintroduce yourself and give us a brief little background?
Sure. Bonnie, it's always good to see you. Yeah, so it's funny, before when you mentioned Thomas, I thought you were talking about me, but he's talking about the actual PW.
That's right.
Yeah, so guys, I'm Thomas Johnson. I'm also a member of KettleSpace. Mac, how you doing, buddy? So I own a wellness and fitness coaching concierge company. I basically saw a flaw in the wellness industry, and I wanted to fix it. So the flaw was the lack of accountability. I noticed that every year people would join the gym, and then after like a month or so, they would stop going, but the gym will continue to charge them. And I also realized a lot of my executive friends, especially in New York, they had this very, very busy lifestyle where they would constantly have meetings all throughout the city, but eat very poorly, and most of the meetings they would end up drinking. And I realized it was a compound effect, right? Imagine having about 8 meetings per week, having 3 drinks per meeting adds up. So I wanted to create something a little bit more of accountability on platform. And I also realized working with my professional athlete clients, they had a wellness support team. They had fitness coaches, stretching coaches, massage therapists, private chefs, etc. And those coaches kept them healthy on season and off season. So I duplicated that same system and I brought it towards the executive section. So now with executives, we have a wellness support team for them. So when you're traveling and you're going out, we keep them accountable of your health. You know, whether it's your sleep, your stress, your nutrition, your hydration, we keep it accountable, and it's been working quite well. And we're based in New York City, but operate nationwide. But like I said before, with COVID, we had to adjust slightly, but things are going well so far.
So, Bob, do you want to try again? I know he was having technical issues earlier. Are you back with us? Or Bob, if you'd like, you can post your information in the chat. Okay. No, I guess he's still having technical problems. Did we get everybody? Did I forget anybody? I hope not. I guess we got everybody. So, Rod, maybe he was having technical issues as well. Rod, do you want to introduce yourself? I guess not. So let's open it to Q&A. Does anybody have questions? People always have questions. I'm not muted, right?
No, you're not muted. It's the uncomfortable first moment, first question. Somebody break the ice. And then,
yeah, come on.
How old is the firm? Your firm? What's the How old is your firm?
So I founded the firm about 5 years ago, and we've been actively investing for most of that period. I would say maybe 4.5 years. Okay. We're in Fund 2 now, and investing actively out of that.
Allison, I'd love to hear about your transition from being a founder to sort of deciding to help other people to like grow and start their businesses.
Sure. My transition from being a founder to being an investor?
Well, to doing what you're doing now, to helping companies sort of grow and go through the process, and like
Sure.
what to do that.
Sure. So I actually, the business that I founded, I sold to a company that was, much larger in the space. I sold that. I stayed on as an advisor, but I could go on and do other things in other spaces. So I went on to be chief operating officer of a startup that was actually founded in Europe, but was expanding to the US, which was in the influencer marketing space, basically software to allow, to more scalability in influencer marketing. I then went on to lead strategy. That was great. We actually wound up closing the US operation because it wasn't really scaling as quickly as it had to. And we struggled raising our Series A. So we went to closing the US office. I then joined a video live streaming startup that was focused on the sports area, so interactive streaming where you could, tap on a player, see their stats, and cool things like that. It was while there that I got connected to MVP. And really, my thought process there was, like I said earlier, I felt that I could, bring my founder mentality to an investor role. Having gone through a few different rounds of funding myself, I always felt like I really enjoyed talking to prior founders. And then also some frustrations when you talk to someone who has never done it before, but they want to give you all this advice. So I thought, I never thought I would go to the investor seat, but I also thought that's a transition that actually makes a lot of sense. And then the final part of my thought process was, doing a startup is really hard. And unfortunately, most of them don't work out. And I felt that, having versus, putting all of my love and energy and time into one company, I could have work in a fund and have a portfolio of companies that I could add value to. And, that would actually be great to have more of a portfolio approach. Less upside, when you're a founder and you own, most of the company, and if it's a success, you're going to do, a lot better than I will. But it's another way to go about it. So that was my thought process. And then from making the transition, I think it was just really right place, right time. There are not that many roles in venture, but MVP happened to be hiring, and we really connected, and so from a timing standpoint, it worked. Am I answering your question?
Yeah, that was awesome. Thank you so much.
Yeah, I'll add a little bit to that because I hired Allison, right? And I always flatter her by saying that she's one of the best hires I've made in my career. Which is, as you can tell from my lack of hair and other things, been around for a while. So I give her a lot of credit. Why did we choose Allison? I guess would be an interesting question. Why did we do that? Because she hadn't done venture before. And I think it's very much her founder experience, certainly, kind of that resume stuff that when you look at what Allison did, that she has that background that we think would be very helpful. It is very helpful to founders, right? People that are purely financial investors, it doesn't really work in venture. It certainly doesn't work at the pre-stage stage because, the reason why accelerators exist and the reason why advisors and people who can help meaningfully are so important to pre-seed seed companies is no matter how good you are, right, there's going to be missing pieces, right? If there are 10 things that are critical in order to succeed as a seed stage company, if you're doing great if you've got 6 of them covered and they're great at 3. So it's always gonna leave holes, and you have limited resources. Your team's never gonna be that huge at that stage. So getting the help you need from people who know what they're doing is important, and knowing that. And Allison, as a founder, kind of brought that to the table, which I think is important sensibility. The other thing I would say that's super important if you're going to get into the business of helping startups, either as just an advisor or an early stage investor or getting involved with an accelerator, is you need to have a lot of positivity and a lot of enthusiasm and a lot of passion for doing this, because as Allison said, it's challenging. It's really challenging to be a founder. If you're going to advise startups, it's the same thing, right? Our world of startups is, as everyone knows, is actually, this is a good I'll riff a little bit here on venture. We look at 100 things, right? And then we invest in 1 or 2. That's the nature of venture. And my experience is that pretty much holds across accelerators, early stage venture, late stage venture. You look at a lot of stuff, you invest in few. So as a founder, that's challenging. right? You got to find your way through. How do you get from the 100th to the, to the 30, to the 10, to the, to the yeses, is really challenging. Understanding our world as investors is very useful. Just like if you're trying to get a customer interested, you got to understand their viewpoint. So I've often found that when I'm advising startups, that helping them get into the mind of the investors is very useful. So you may be doing that intuitively, but it's probably a good idea to do it even more explicitly as a founder. Try and do that. So part of that viewpoint is we look at a lot of things. We have to make quick decisions about when it makes sense to devote more time. If we're good investors, we got to provide feedback, or we want to. It needs to be quick though and succinct. And then we move on to where we see more fit and opportunity. And then the world of venture is, if I invest in 10 things, I would expect 3 or 4 of them to go bust and I'll get none of my money back, right? And 3 to do kind of okay, right? Maybe return their capital or close, or give me a 1 or 2x on it. And it's the top 3 or the top 1 that drive all the return, right? For the portfolio. And again, that's something that holds up pretty much across all venture with few exceptions. And you got to believe all 10 of those are going to be 10xers, right? And even with that, and with all the help we can offer them, it's that top 3 that are going to succeed and drive all of our returns as a venture investor. So understanding that mentality, and just going back to Allison and this notion of positivity, you got to maintain and have have that enthusiasm, have that stick-to-itiveness to come in every day as a founder, and for us as advisors, and continue to be able to help and weather through that entire process. More questions. Come on, guys. Yeah. More questions.
I have a question. Sorry, I had a little trouble getting off mute. I have a question for Allison and Thomas. Because you're in the front lines and you're seeing those hundreds or thousands of companies, are there any trends that you're picking up, especially ones that might not have sort of made it into the conventional wisdom? And I guess I think of trends either in terms of verticals, telehealth or back office automation, or in terms of tools that people are building, whether it's AI, facial recognition, machine learning, and those sorts of things that can be used to power across multiple industries.
Allison, why don't you go first?
Sure. Yes, there's always trends, and that's a good, can be a good thing because it just shows that there's opportunity in the market. It can also be tough too, because it means that there's a lot of stuff to look at. So there's a lot of competition. So one trend that we've seen and we're leaning in on, we think it's interesting, is technology in the supply chain. Supply chain's a very traditionally very paper and pen based business. It's a very relationship driven business, but it's just riddled with inefficiencies, a lot of lost revenue across the supply chain. So, and Newark is based in Newark, which is the second largest port in the U.S. So we happen to have a big kind of growing network of operators. Panasonic's one of our LPs. They're heavily involved in supply chain technology. And then we get a lot of inbound from people who have supply chain tech. So that's like a new area that's looking to be really hot. And we see, more and more activity, more and more startups in that space really kind of every day. And I'm focusing on your vertical question. The second one, when you look at health tech, is telemedicine for sure, telehealth. So COVID has, I think the idea of telehealth was always, why isn't this a thing? But to download the app and actually do it, people just didn't do it. And then COVID came and your kid has an ear infection and they're like, you have one choice. You can do telehealth. So people had to do it and they experienced it and they're like, wow, this is super awesome. This is really easy. So that's an area that we think is really interesting. We are looking into it. There already are a lot of players and there's a lot of competition. But that's another one. And then the third one, so we're definitely interested in that. And then the third big trend we're seeing is startups in the podcast space. Audible is a big LP of ours, and they're interested in the podcast space. They've traditionally audiobooks, but podcast is emerging as this next new media channel. You know, when you get home from work or you end the day at home and you want to just relax, used to be you turn the TV on, and now they're like, oh, I'm going to listen to that podcast I really like. So that advertising bucket is still really small when you compare to traditional media, but it's growing. You see Spotify doing a lot of deals, some really big content deals in the space. We agree that it's a growing market, and we're interested in we're leaning in on it.
Mm-hmm. Yeah. I'll first sort of riff on what Allison said. So probably each of those was super accelerated by COVID, right? As big a tragedy as COVID is for kind of everybody, it's totally accelerated telehealth. Telehealth is going to happen anyway, and this notion of, I'll say more generally, instead of health being delivered by the traditional model of going to an appointment and seeing someone and this being a gating factor and for all of us getting to an appointment, and for lots of people just getting care, right, depending upon where you are in the economic spectrum. And it's just taken this thing that was inching along and doing well, and bam, just opened it up. Everybody's doing Zoom, everyone's doing telehealth. It's totally natural now. So we've all been exposed to it. We're not going to be going back, right? The economic model around doing that is just so superior in a lot of ways, being able to get care through a video conference or whatever it might be just fills a huge need. It doesn't replace it completely, but again, that's one of these things where it took a trend that was out there and just accelerated it. We're not going back, right? And to build on that, I'd say, like, for travel, and I like the travel space. I've actually made a number of investments over the years in it. Obviously, from one perspective, it's like, bam, where all of a sudden all travel is, dropped. We have a travel-based startup that does, it's a platform for vacation rental owners. So people who own a few properties and are listing their property on Airbnb and other places. This is a platform for them to run their business far more efficiently. And they saw an 80% drop in revenue, within a month. But they've also seen a trend where they're attracting more and more owners to their platform because of the need they now have. And if you think about some of the other changes in travel that, are one just happened as a result of COVID, but you just aren't going to go back, I think. Like business travel, there was a thing that we all did as business people, which was, hey, we got to have a meeting. It's really better to do it in person. So I'm going to fly all the way to Europe or the West Coast, have a couple of meetings, and then turn around and come all the way back, right? And face-to-face meetings, I still think, are better in most cases, but that's tough to schedule, and that's a lot of work. And I think that kind of business travel of going a long distance for a small amount of benefit is just going to stay diminished, right? Because it's just not as efficient. And then there'll be a premium, absolute premium on those meetings that you're able to do in person that we should all take advantage of. Not going to disappear, but we'll see that premium. And then I'll make one more comment before I close off, which is, as fun as it is to look at trends and to think about those things that are happening, and as entrepreneurs and innovators, we need to stay on top of that. If you're thinking about yourself as you've got an idea, you've got a company, and you're looking to figure out how to get it financed or get the help you need, probably 90% of what you need to do doesn't change, really doesn't. Right? It's the fundamentals of pitching and running your business and all those things. So as fun as it is to think about trends, and is maybe as important at the margin to know kind of what's happened in your space and be aware of things, it can also be a distraction, because again, 90% of what you need to do doesn't change based on trends in order to be successful.
Next question.
I have a question. I have to jump on early. Sorry about that. So this will be my last two questions.
You can ask as many as you'd like.
Yeah. So the first question is, can you give us an example of a company that you're both proud of, and why? Was it because it was a risky company you invested in, and it was your thesis, and what made it successful? How did your team be successful? And the second question is a little bit more of a selfish question, but at Kira, we fundamentally believe that in 10 years, most people will be able to have local, healthy food prepared for them and personalized to their bodily needs within a 5-minute to 1 hour window. You can imagine that's challenging, but we have what we believe to be the only scalable approach to personalized nutrition. What would be your main question regarding arts?
Allison, do you want to start?
Sure. An investment that I'm proud of. So one Tom and I have really been closely involved in is a company called ClassTag. It actually was my very first investment with Tom when I joined the fund.
I didn't know that.
Yeah, very.
I didn't remember, I should say.
And the company, what it does, it's a digital platform that manages all communication between parents and teachers. And interestingly, the parent-teacher relationship is the #1 indicator of childhood education success. And unfortunately, it's a very challenging one to maintain because usually it's done with, paper forms that are sent home. You're dealing with parents who speak different languages. You're depending on your kids to deliver communication, and you can't depend on that. So Lada Lakina, the founder, she created a platform with a really great technologist who was, actually an inventor of e-commerce. He started a company called CD Now that went public. They created a omni-channel digital platform meant for that purpose. And their business model was kind of, very different when we met them. They don't charge the teacher. They fund the platform by bringing in brands who advertise on the platform, but in a very kind of sophisticated way. Like a Target will sponsor a classroom, so non-intrusive ads that are delivered. And the interesting thing is that the creative thing that the company did is they said, we're going to take 30% of this advertising revenue and give it right to the teachers. So finally, teachers have their own budget to pay for supplies. Interesting fact, on average, every teacher in America spends $500 out of their very own pocket to buy supplies for their classroom. So the model, typically we kind of stay away from advertising models, but we really felt that, wow, wouldn't it be nice to finally give teachers their own budget and to have a growth model where it's really bottom up. Teachers bring on the platform themselves, and then eventually, down the road, a district would say, oh, wow, everyone's using this, and let's take it on, similar to, Dropbox, for example, how they grew. And then, the team, Lada, I happen to know her from our Wharton. We both went to Wharton, and I knew her from that network. And she just has, she's a go-getter, very driven, and smart. And then with Jason, her co-founder's background was really impressive. So they could not raise venture, actually. Lada is a hustler. She got in front of every VC, could not get an initial check. We were the first institutional investors in. Our bet was really on, this is a problem that needs to get solved. This is a great team, and we think this is a business model that, while a little odd, we actually think makes sense. And then, they grew since the moment that we invested, and then COVID happened, and as you can imagine, the business has just exploded from there. And, now, you can have Zoom calls with your kids, but how are you communicating with the parent on everything that's happening between the Zoom calls? We do that on ClassTag. So they've raised, I think, around $5 million now from, other really great investors. And, they're off to the races. I don't know, Tom, if you want to add anything to that.
Yeah, I do, and at risk of kind of overdoing it here, but I think these stories are useful, whether or not you're in that sector. And this is a good lesson, just as a founder. You can always learn something by what's going on with someone else's startup, because again, 80% of success is going to be some version of the same thing. So there's a lot to benefit, I think, from these kind of more in-depth stories about companies. So what I would say about this, it is one I'm really proud of. Allison's brought it up, and one of the reasons why I'm proud of it is because I saw this thing and I loved it from the beginning, right? And I could not interest other investors in it at the time. I was in a way kind of shocked that other people were still wary of it. And now we've shown them all to be misguided because they've been such a success, and many of them are sort of, whenever I talk to them, God, I should have jumped in when I could have early on. So why though? Well, it's ed tech, and as an investor in ed tech, or as someone outside, ed tech is a graveyard of great ideas, great founders without success, and in particular, ed tech aimed at K through 12 in that stage. And there's all sorts of reasons. It's a really slow industry to buy anything, kind of like government, or, I don't know, what else would even be close, but large institutions just move so slowly. And education, for all the reasons we know, we're in kind of in a crisis in America, just doesn't even make economic decisions or sensible decisions because it's all the crap that's going on. So it's even worse to try and get something. And they don't have a lot of money. So, why are we barking up this tree as founders trying to sell into an industry that's super slow, irrational in how it buys, and at the end of the day, doesn't have a lot of money to spend. So there's no shortage of problems there. If we zoom in now on grade and grade school and K through 5, no shortage of problems. Teachers in crisis, under-resourced, and such an opportunity to both provide help, right, to them and to the school system. And it also sort of has a good feeling about it because there's a social benefit, right, that obviously comes from helping here. But it's just really hard to crack in there. So most investors are really wary about it. Almost everybody has like a startup they invested in if they've been at it for a while in ed tech and how much of a train wreck it was ultimately, not through lack of trying. So when this one came along, though, it just clicked to me because for a number of reasons. They had solved a bunch of these problems that have held back ed tech. As I thought about ed tech kind of prior to this, like, why specifically is it tough to do this? And what are those things you're going to need to overcome in order to be successful in this thing? One of the key ones in there is you can't getting the educational institutions to pay for anything is really tough. So as an entry point, free really is a great thing, right? And that's where you've seen success here, where people are offering like free platforms and going at the ground floor, right? Not trying to aim at the enterprise level initially, but going in kind of like a Dropbox strategy, where you just get people to start using it, and then you can trickle up. And that still hasn't been terribly successful in it, but at least it's an entry point there. And these guys go a step further. Not only is it free, it doesn't cost the teachers anything, it pays them, right? I mean, that's brilliant in a way, right? Because it's heading, it's moved from trying to get people to pay for something that don't have a budget, at the institutional level, trying to get people to pay and use something at a teacher level, and they're so busy and they don't have a lot of money, to free, to they're paying for it, right? And how do you do that? Well, it's an advertising model, and you think, God, advertising to kids, and teachers, and parents, that sounds like something that people aren't going to want, right? But what they found is that if it's the right kind of advertising, people actually want it, right? And why? Well, one, it's helping the teachers. So you as a parent think, yeah, that's great. I'm willing to have that ad sit there, for me, because I know part of that money is actually going to the teachers, and therefore I've got this much more positive feeling about it. And as an advertiser, you really want to get in front of parents. It's a great audience for a lot of different products, but you also want to get in front of them in a manner, in a tone that's beneficial. And how much, again, they're helping, they're sponsoring a platform that helps parents helps teachers, creates this sort of halo effect there. So advertisers want to get in. And as long as they understand and they're monitored, they're not spamming people or trying to sell them something that they don't want, right? As long as that the brands fit and both the advertisers and the platform understands it, it's, people want the advertising. Now that's again, just this breakthrough in how you do that. And I just saw these things like, oh yeah, well, advertising, how successful could that really be? You have to, as a parent, opt in to advertising. And over 80%, I think close to 90% choose to opt in to advertising. Think about how amazing that is. That just speaks to their to their model. When I looked at usage there and how passionate the teachers were about this platform, this tool, it had this cult following. and teachers are very well networked, and the recommendation from one teacher to another is super powerful, right? So then you have a viral effect in what is kind of a B2B context, right? Not a consumer one, right? As a teacher, I'm using this for my profession, for my business, but yet virality works, and virality doesn't actually work very well in the SMB market at all, right? People will bet on it, but there isn't a lot of benefit that's sold from it. Not like consumer, where if you're really excited about a consumer product, you do tend to tell people, you get on social media, and around SMBs, it doesn't work terribly well. But here, if you think about them as an SMB, teachers as an SMB, and classrooms as an SMB, they wanted to, right? And this thing, I have one more thing, and the existing players in the industry weren't doing this, right? They were all trying to sell at the enterprise level. There was some success out there that you had to be a little wary of, but these guys were killing it. Even with all that, we struggled to get them financed, but we succeeded. We ultimately found the right amount of capital early on to generate another year of success, to generate more interest in investors, and it has it's been a stretch, but my dog is barking. Like Allison said, they've gone on to raise capital, and they 3x'd, I think, last year. And COVID came along, and all of a sudden, all class turned virtual, and you need a platform to stay connected. These guys have become kind of a de facto learning management system, and have an opportunity to expand beyond just this core kind of communication platform. So it's one of those businesses that's, they're probably going to 5x this year, which is crazy, right? But that's, huge benefit, one we're getting back to it, super proud of. There are many others, right? There are 20 companies in our portfolio that we've put more significant amounts of money in, and there's great stories probably about, I know about all of them.
So cool. Incredible story. Definitely want to follow up with you both on that.
Oh, I just wanted to add, sorry. Oh, I wanted to add one thing, that EdTech, which has always been the ugly stepchild of the investment world, is suddenly one of the hottest areas for investment.
Well, I do have to step away a little bit early. I'm so sorry, but thank you for answering my questions and inviting me to another great event. I'd love to follow up with both of you, and yeah, stay safe and healthy, everyone. All right, I just have to jump on another.
Thank you.
No worries. If anyone needs to leave, obviously that's fine. That's business and other things. If you want to hang around, I do have some more time to hang out, maybe for another 15 minutes or so, and continue kind of to answer questions live or talk about stuff.
No, I'll jump in if you don't mind then. So we were talking a little bit earlier about remote work and kind of the shifting dynamic that COVID has created. It's great to hear some of the examples of how it's been a catalyst for growth, but for a lot of companies I know, it's been a challenge. Revenues 10% of what they were year over year, and so in some cases, and a test of teams where they have to cut down their burn and spend a lot less than they were expecting to. I'm curious, about NVP. You're located right next to New York, so you see kind of the higher end of the spectrum there, and startups that are pre-revenue and have pretty high expenses. I'm curious to hear sort of your perspective and how it's shifted about, for B2B clients. I think it's pretty important to have access to those big clients that are located in cities like New York. But have you advised your teams to move out of expensive areas, or cut back on those types of co-location expenses, and have your teams gone remote?
Allison, why don't you start?
Sure. I will say that we're definitely, happy that we invest in B2B and not B2C companies. Now, from the B2B standpoint, yes, deals that were far along and then COVID hit they got stalled, or many of them got stalled, or maybe they're not happening at all. So we absolutely did very quickly advise our companies to cut costs. And I think it was actually, I mean, it's actually, if you think about it, you can think that's an opportunity to think about what you really need within your organization right now, and make those hard decisions, but in a way try to align yourself for maybe even a better footing for going forward. So I think it was an opportunity for our founders to really just have a very honest conversation with their teams on what resources they need and maybe which resources they did not need. I would say that for the B2B companies that are where things are working, and it can be pretty obvious when things are working. Product market fit has happened. The business is starting to scale. Even with a stall in sales, venture investors can see that progress. And we even thought of an opportunity to invest in the companies that are working, and maybe sales will slow down, but it's working. There's product market fit, and we see massive potential. We did encourage our founders to also, shore up capital, take in capital where there were opportunities to take advantage of PPP. So we were able to invest in a few companies where we're like, things are working, we want a bigger stake, and let's invest more. So we had companies who raised during this difficult time, and there's still a lot of venture capital to be put to work. So that was an interesting conversation we had with our founders. And then my last point is, we're based in Newark. We have co-working space in Newark. I think we've always had, to our founders, have had that kind of lens where, don't spend where you don't have to. Come 18 minutes outside of New York City, base your company here, lower your expenses from a salary standpoint. Our space is free. So I think, we probably have attracted those kind of founders. We've kind of, imparted that kind of, wisdom on our founders. I don't think we have any, frivolous spenders. And already we have a lot of companies who are taking advantage of our space. We have about 35 companies based in Newark. Actually, they're not paying rent right now. So it's already an advantage that our portfolio was able to take advantage of.
So thinking about your question, right? First of all, I think as founders and investors, it's always easy for us we have to be able to look at the bright side and find goodness, and we also need to be pitching constantly. So it's easy to kind of put a good face on everything. And we have had companies, we do have companies in our portfolio that are doing well as a result of this. Health tech, given the crisis, nearly every health tech company we're involved in has seen some kind of a jump, and that's great. But I think your point is a good one. There's a lot of founder hardship going on right now, right? Even in our portfolio too. It's, if you're a business-to-business company, right, all of a sudden everyone in business, has got to go remote, and they take their hands off the whatever the right metaphor is, foot off the accelerator and wait. And all decisions, for enterprise software get pushed out. There may already be long, and as a startup, the difference between getting a sale done this month and 3 months from now is like, that's critical, right? So there's enough pain to go around, enough challenge, let's say, to go around as for the majority of companies probably out there in the B2B world. I think from a space standpoint, you asked about, did you recommend giving up space, tell them to get a space? Actually, no, all of them just dropped it immediately because we're all virtual, right? So every single company, I would say, without fail, without, I can't think of any exceptions, gave up their rework space, or rework was already getting kicked down, and they're down, but they all dropped immediately because they weren't going in, and it's an expense, so they dropped. And we're all working virtually, and even our space, I think as Allison said, one of the things we say is we have this beautiful space. We didn't even talk about that because that kind of space is off people's minds. But we have a 25,000 square foot space. We're right in the same building with Audible, part of Amazon. We're in the middle of the Rutgers Business School, and we're able to offer that great space. All the amenities totally free. right, to our companies. And we say free forever. We mean it, right? We're never going to kick you out, right? Or we haven't had to, let's say, anyone out. And it's free forever, you know. So, and we've got that benefit, and it's a great fit for some companies, and they really, really value it, and able to take it. And then for some, it's every once in a while, and that's okay too. I think for us, we are going to get back into that business. We very much want to get back into that, I think, business, but that aspect of our investing, one, because we believe in it, and we gain so much from having founders outside our door, right? You know, so many companies I think I've ended up investing in and being able to help, you know, because I know exactly what's going on, but I'm going to go outside my door and I'm running into them all the time. I really want that back. I also think, given our Newark mission, people on the ground, companies actually there is part of success for that part of our model, right? You can't impart economic growth at any significant level, or so much more economic growth, if you're there. You live there and you work there. That's what creates urban comebacks. So I think we are very much going to get back in the business of being in Newark and trying to encourage companies to grow there. They'll probably still have virtual, but we want to find the few that really find benefit in being there, and can help with that aspect of our mission. A couple of things I wrote down. You mentioned about NYC startups, and you know, I know that's definitely a difference between kind of what you described as your focus, given PA and Pittsburgh in particular. Actually, it's the opposite. We look to mine the best startups from everywhere and then bring them to Newark or expose them to our platform. And we actually find those, call them secondary markets. Sounds bad if you're in one of those, but the markets that are outside of New York and the West Coast as being great places to find startups. And we've built a model around finding them that Allison didn't get into, but it is important to us. So we love those teams that are outside there. You know, so I would say a third of our companies we've invested in come from somewhere else, meaning they're not even in New York. They haven't been in New York, right? They're maybe overseas or they're in Atlanta, but they see a value in coming to the US or coming to New York market in particular. So we help them do that. About a third of them are already in the New York area, have moved there, but haven't anchored yet, maybe, or you know, sort of see an advantage in that. And then there's a bunch that are actually already in New Jersey, and that's easy. But we can't limit ourselves to just that. They're already in New Jersey, or already in Newark area. But our model is very much about you know, the entire scope of companies, and then interesting them in our platform, and you know, bringing them to Newark. The last piece I'll say about kind of the current environment, and why perhaps the shock that I think we were fearing, and I think a lot of founders were fearing in terms of capital, hasn't really emerged. Certainly capital invested is down, but not at the level I actually thought, right? I was thinking kind of financial crisis level, where everybody took their foot off the accelerator and it took 2 years to come back. Certainly we've got a long road ahead of us, but what we found, and I think we're an example of this, we've got money to invest, right? And we think if you historically investing in at the quote unquote bottom of the market or during troubled times is proven to be kind of one of the best places. So it gives you sort of some, that we're, you know, we have funds, the long cycle funds exist as vehicles for 10 years. So we have the flexibility to think longer term, right? Our investors have committed to us. We've got dry powder. There's a lot of dry powder. I mean, the last 2 years have been a golden age for venture capital in terms of fundraising, in terms of new firms. So there's people out there willing to, and nobody wants to miss out on something, right? So if there's a good startup, especially one that's aligned within COVID, that's great, right? Or one where it may be struggling, but it's a diamond in the rough, and you see how it's going to outperform, you know, in the medium term. So.
You know, I know that we have
questions. Oh, sorry, Bonnie, go ahead.
Oh, I know that some people, and I will take your question. I know that some people have to leave soon, and I know Mac wanted to say something about KettleSpace and the sign-up form, right? Mac wanted to make sure that you got that in before people had to leave. But I will get to our numbers.
Okay, thank you, Bonnie.
Thank you, Bonnie. Yeah, I just wanted to drop in an event survey here. You guys copy and paste this link and fill it out maybe after the event. I'd really appreciate that. Drop that here. And then just want to say later today at 6 p.m. actually, we're hosting another event on kind of flexibility, how companies are adapting to remote work. Now they're kind of reconsidering their perspectives on employee flexibility. We're going to have a panel of people from the company perspectives as well as the employee perspective, talking about kind of the future of flexibility. So if you're interested in that, I'm also dropping our event page. You can RSVP to that there. That's all I have. But yeah, I just want to thank Thomas and Allison for joining us again, and thanks everyone for joining us. Back to you, Bonnie.
And Pia. Sarah.
Thank you, Bonnie. So for those of us who are new entrepreneurs and are new in the investor scouting field, would you be able to tell us a little bit more about sort of what is the standard process to identify and engage with investors? Sort of what are some of the more common arrangements between investors and new companies? And what are some of the not so obvious things that investors are looking for in new companies?
Go ahead, Allison.
Sure. So finding the right investors, I think there's many ways. One is, Googling. You can actually just, Google what are the funds in New York City. If you go to their websites, you should be able to understand where they invest, at what point they invest. There should be some clarity on the website. You can go to Crunchbase. You can look at their past investments. Okay, so I see they're leading in seed rounds. Okay, that's a fit for us. I would say tapping into your founder network is huge. Investors love to get, referrals from other entrepreneurs. Helping understand who invested in your company, why were they a fit for you. And then I also find that, alumni networks can be helpful as well. So I would say tap into that. And then, once you find the right set of investors, it is always nice to get a warm intro. We look at every email that comes our way. We look at every cold email. Well, unfortunately, a lot of funds are not like that. So do try to get a warm intro if you can. As far as arrangements go, this is why venture funding is so, I think, difficult for founders, is that there are no rules. And, every, investment is a negotiation between a founder and an investor. Founders who've done it before, they tend to be really good at it. It's something that you get better at over time. But I will tell you, the traditional path we see is, a founder will go and raise some family and friends and angel money. It can be, 50 to 100K. They are, able to build some sort of MVP. Then they could do an accelerator program, or they'll come to like a Newark Venture Partners where we put in 100K. That typically leads to like what we call, it's a pre-seed round, 500 to 700K that's raised on a convertible note or a safe. And then after that, an institutional seed round, 1.5 million, maybe up to 2.5, typically a priced round. It doesn't have to be though. So, and then after that, it's usually priced rounds. But you see convertible notes that are opened after an institutional seed because there's a lot of interest and someone does a step up in the valuation and they open a convertible note. So, there are no rules. It's about you understanding what your investor's interested in, and you as a founder understanding what you're interested in giving up as a founder, and taking it from there. Basically, I guess the only rule is kind of you want the valuation to go up over time. That makes existing investors happy and future investors excited about you. So, try not to get over your skis. I think sometimes, that's just something that's just, a piece of advice there. There's a great book that I tend to recommend to friends that want a little bit more. I'm trying to find it now. Advice on fundraising. I'm pulling it up, and I forgot the name. And then my last point was what is a founder looking for, or what is an investor looking for? I mean, I would say there's nothing that's like it's usually kind of the same stuff. Is it a market that's big enough where they can get the exit that really a venture fund needs to give the returns to their investors? Is it a team that's the right team for that business? Does the team have the right experience? Is traction impressive? Does it align with the amount of capital that has been already invested into the company? And then I do think there's an element where, investor wants to know that this founder can raise more money, because it's more money. Do they have that ability to raise? That's just, I think, something that founders look for. The book is called Venture Deals: Be Smarter Than Your Lawyer and Venture Capitalist. I really, really like this book. I'll put it in the chat. I recommend it.
I say that. I was going to add.
I'll add a couple quick points, and I know we're kind of at time. So what I would say to you as someone newer to venture and founder role is that actually I don't think the problem is any lack of advice. Actually, I think as a founder, there's just too much advice. Like if you Google what's a good pitch, right? It's like boom, too many things. And then one person's saying, put your team page up front. Someone's saying, I believe it there. And it's like every time you get some advice, the next piece of advice seems to contradict it. You're sort of left with this, how do I figure this all out, right? So how to reconcile all that is actually kind of a key, not only as a new owner, but all the way along, because you're going to be getting conflicting advice. And what I would say is that just on that point, that launching into kind of a lecture about it, I think there is a lot that you could talk about there. You got to go a level deeper than just the surface. So do we take pitching and what the perfect pitch looks like? You'll see somebody's perfect pitch in 10 slides and line it up with somebody else's, it's say 15, and you say, wow, there's just differences there. I would posit that 80% of it, maybe more, is actually the same. And what an investor really wants to see or needs to see, whether they say it or not, it's probably 80% the same. But you got to go a level deeper, right? And try and understand the why behind, someone is suggesting put a page up front or in the back, or why, I'm saying do friends and family, and someone else is saying try and do some other kind of round. It's reconciling all those points of view, trying to get to a level deeper and realize, oh, you know what? They really do want to see the same thing. Or yeah, that person didn't mention that, but they still value it. So you got to go a level deeper, or try to go a level deeper. Keep thinking. And the last thing I'll leave you with, Charlie O'Donnell, if you don't know him, you don't see his you don't know his newsletter, you should. He's a great guy. He's a consummate networker. Great, he kind of drives great community in the venture and founder world. And I have a lot of respect for him, both as founder and an investor. And as I said, I'm an investor in all three of his funds. He said to me at one point, he said to people, I really respect this. In this case, it was a salesperson. And he said that the salesperson is a student of sales, right? The notion of being a student. Now, how could someone who's really good and a master be a student? And the point there is, no matter where you are, you can learn more. And pitching does not come naturally to 90% of everyone. It's a learned art. But that's a good thing, because we can all learn. We have to go through that. And the path to learning is, think about it, maybe get some resources, try, put something together, actively share, and then circle back and keep going around. And that's notion of continuing to be a student about kind of everything, and that getting into that mode of no matter who's talking, I can probably learn something from them. I can probably pull a pearl of wisdom out and have it reinforce something I've heard before, or give me some insight once I've applied it to, my situation.
I want to add one thing, which not a lot of people mention, is that also look at the size of the fund. If it's a huge fund, if it's a multi-billion-dollar fund, 20x, 30x exit means nothing to them as opposed to a smaller fund, which wouldn't, right? Am I wrong, Thomas?
No, you're right. And thinking there's an hour-long discussion we can have about sources of capital and how different they are.
Yes, I know.
And I love talking, as you probably noticed. And I like to think I'm a party wisdom, but I will say yes. The point that Bonnie's making is as investors, we are working in that. I invest in 10 things. One or two, are going to be the ones that drive returns, and it can vary a little bit, but it still holds as a thought. However, as an angel, a founder, or a smaller fund, if I get a 2x, a 5x, it can be much more meaningful to me, right? Because I don't have a lot of overhead as an angel, right? Or a family office. And I can play the shorter game. If I'm managing money for somebody else and I'm taking a piece of it and trying to return a profit to them, and I've got staff and all these other things, I've got to aim at larger X's and got to believe that there's 100X out there somewhere. And if I don't believe it could be a 10, I just won't take it. And angels are more willing to and can do well with smaller X's. So therefore, their risk tolerance or their viewpoint is just a little different. So they may be willing to take you on, even if it's not obvious you're going to be 100X.
Thank you.
So I don't know how much more time. I know that we're a few minutes over. Do you guys have to go? And I'm happy to have you on again.
Why don't we do one more? Why don't we do one more question?
Okay.
I've got one last one.
Sure.
As an investor, what's it like to pass on a deal and then see it grow into like a multi-billion-dollar conglomerate? Like, does it haunt you for years after?
It's great. It's a great question. I don't know how it benefits people other than to know that there's humility in the world of investing. One of the reasons why one of the venture firms has been around forever, Bessemer.
I was going to mention that.
If you look at their website, they have something called the anti-portfolio, and it's all the things they failed to invest in that ended up being as like spectacular successes. And they have a little blurb about like what happened, why they didn't invest, and it's great. And it shows that there's good investors do have some humility and understand that. And they passed on Google, I think, right? And they passed on, and they're like, oh, I didn't like him, or I thought search engines, what's that going to be, right? And yes, it's important to know that, as arrogant and confident that we may seem as investors, every investor is haunted by the fear of missing out, right? And whether they'll pass, and then I would say everyone's like, man, okay, either I wasn't enthusiastic enough and didn't invest in that, or I was too enthusiastic, invested in the wrong thing. So we're all kind of constantly doing that. So I don't know that it haunts us, but it could actually, if you were that, or you got to smile and say, I'm imperfect, as good as I can be. I'm not going to see everything. I'm going to pass on stuff. I got to accept that, because if I got broken up about it, for too long, then I'll fade out of the industry, right? So it self-selects for people that can sort of deal with missing out, and not let it totally disrupt them. But yeah, fear of missing out is a big one, and we all, keep feeling those wounds we have from not investing in the Googles. I didn't pass on Google, but I passed on Pinterest. I was an angel then in New York. Their first set of investments, first investment they took was from New York Angels, and I was an active member there, still a member. And they came in as a totally different startup called Tote. And I'm like, this isn't going to work. This guy is amazing, but this isn't going to work, right? And only 2 people invested out of the group, and I was right. They failed. They got their investors to put more money in. They failed again in the sense that they ran out of money, and then he pivoted, and it became Pinterest, and it was this huge success. And again, only 2 people of a group of 100 had invested in it, but they did very well. It's probably 1,000x or something like that, crazy. You're going to miss them.
In fact, in 2 weeks, we're hosting our next breakfast, and our guest investor is going to be Brian Cohen of New York Venture Partners, who was one of the two who invested.
Yeah, and if you know Brian, he's a super great guy, but he will make sure that you know that he was the first investor in Pinterest, and it's definitely made him in a lot of ways as an investor. And he's a smart guy, and he's made a lot of other good investments, but he was one of those two. He did invest, and I think he put 25 in or something like that. And I don't know what he's made off of it, but
let's just say he bought a second house in the Hamptons, second home in the Hamptons.
Yeah. So, but he's one of those people that you're okay with having him done well, because he's super nice and gives back and all those things. Besides him continuing to remind me that I didn't invest, I love Brian.
I don't know.
Okay, well, that's great. Great meeting all of you. Good luck kind of in the next part of your journey. As Allison said, we are wide open to outreach. Kind of all we ask is that you kind of listen to what we've said and think about fit, right? So if you're really serious about being interested in our potential investment, then you've heard kind of the stuff that we are looking at. If you're just looking for advice on something, we can try to help. And we do read all our emails, and we like to respond wherever we can. So certainly anyone on this call that we've had an opportunity to meet, you'll just mention this meeting, because we do receive a lot of email and we need reminders, and we will be responsive. Allison, anything you want to close with?
I copied that, and I put my email in the chat. So yes, please feel free to reach out. Thank you for your time this morning, and it really was a pleasure meeting all of you.
And don't forget, they have a deadline coming up in September. It's not really the 21st. It's really the week before. I'll change that in the newsletter. So if you want to,
the key is don't wait. If you're interested and it fits, apply now, right? Because we will make decisions on a rolling basis. We don't wait to the end. If we like you and we get it, you're in next week, and we can start the process already. So don't wait. And hey, guys, help us out. Tell your founder friends, anyone you know, right? We're good guys. I hope it's come across that we are. We look at this kind of startup, and if you're a match for them, we love founder referrals. We love that. So help us out, and we'll continue to try and help you guys out.
Thank you, guys. Thank you so much. And thank you, KettleSpace, for hosting. As I said, if you want to sign up for the newsletter, startuponestop.com. And in 2 weeks, we're going to have Brian Cohen. Mac, are you there? You might have left.
He gave us his closing remarks already.
Yes, he did. Okay, thank you, everybody.
And he put the links in the chat.
Yes, don't forget the links. Thank you, everybody, and hope to see you.
Great.
Thank you, too. Bye.
Good day, everybody.
Bye.
Bye.
Bye.